Welcome back to 15 Minutes of Finance. This is the tax plan, where I help you keep more of your money. On today's episode, we're going to talk about estate and gift taxes. And they might seem like maybe separate topics, but we're going to find very quickly that these topics are inextricably linked and that there are thresholds that are combined between these two concepts, and that maximizing gift planning can also help your estate planning. Let's get into it. So the estate tax is a concept that you'll also often hear as the death tax, and that's because the estate tax is a tax due upon death based on the total value of your estate when you pass. This becomes a primary focal point of what we call estate planning, also kind of referred to as legacy planning, but it's often called estate planning because it's planning around your estate and minimizing the amount of taxes you're going to owe in estate taxes when you pass. There are a couple very important kind of points or fundamental concepts to talk about before we get into the planning element. And I want to preface with this. Estate planning is an incredibly complex topic. It has so many different elements to it, and to plan an effective estate, especially for someone who has relatively high net worth, you're going to need multiple people on that kind of team that you assemble. There's going to be a lawyer involved, maybe multiple lawyers. They're going to be necessary drafting up trusts. You might have a will. You might have other legal documents that you need reviewed. You probably have a financial planner or an advisor or a CFP, someone like that on your team that is worried about how do we manage the assets that are in a trust before you pass? How does the assets in the trust, how do they pass down to your descendants upon your death? You probably have a CPA involved to maximize the tax implications. So there are a lot of different elements to estate planning. We're not going to get into the entire comprehensive kind of process of forming an estate plan. What we're going to talk about is understanding these estate/death tax limits. How do we plan around them? What are they so that we can plan for them? And how do we utilize gifts and the gift tax yearly exclusion to maximize our tax planning when it comes to our estate? So let's talk about what the estate tax even is and who does it apply to. And the answer is honestly, not very many people. It does not apply to very many people, and we're going to see why in just a second. But if you think this episode doesn't apply to you, just wait a little bit for the gift tax section. That applies to a lot more people, whether or not it relates to your estate plan or not. But to sum it up for you, the estate tax is the tax upon death of the total estate value of estates valued at, for 2024, $13.61 million above. And that's per individual. So if you're married, your estate tax exclusion is just over $27.2 million. So what does that mean practically? It means if you and your spouse pass away, you can have an estate of up to about $27 million that is not taxed, and the full amount can go to your qualified descendants or beneficiaries or whatever you want to call them, the people, oftentimes kids or grandkids, that you're leaving your estate and all of your assets to, okay? So that's the estate tax. Obviously, you hear that number, $27.2 million. A lot of people are going to go, yep, I'm good. Don't have to worry about taxes upon death. And that's most people. Obviously, if I died today, I would be in that boat as well. So no shame there. Most of us, the estate tax itself does not apply to, but it's a very important thing to consider and a kind of planning consideration for high worth individuals. And here's why. If you think this tax will apply to you, the tax rate is incredibly high. So as soon as you are above the exclusion, right? So it's going to very quickly marginally increase the tax applied to any assets above that threshold. So let's say I have $15 million. I'm not married. I pass away. I have, $1.4 million. By the time I'm up to that $1 million, I'm already at a 40% tax bracket. And that's where the estate tax bracket caps out. So if you are going to die with an estate of $50 million, let's say, you've got almost half of your estate where the estate tax is applicable to. 40% is a heck of a tax bracket on $24 million, right? $23 million. So estate tax is incredibly important. So that's the reality of it. If it doesn't apply to you, that's most of you, great. You don't need to consider it. If it does apply to you, it's going to be a real kind of wedge into this estate, and you could be paying a lot in taxes out of your estate before that remainder is left to your descendants, okay? So it is incredibly important to think about for those who are high net worth. Now let's talk about, or let me actually cover one last thing before we get into the gifts, and then we talk about the way that they are interlinked. So one really important thing to consider and just understand is the concept of portability. And what that word means in the tax world is that one person's exclusion can transfer to another. And so this is relevant in this topic where we talk about, you probably heard the first couple minutes and think, how many spouses die together? Like, that's got to be pretty rare, right? Like, maybe it happens in a car crash or something, but for the most part, one spouse will outlive the other. And so that's where we have the concept of portability. And we have the total $27.2 million marital number exclusion, and that gets transferred. It has portability, so it's ported to the surviving spouse. So if my wife passes away and she leaves everything to me, there is a marital exclusion where you can leave any amount to your spouse. And that makes total sense, right? You're high net worth, you pass away, you lose 40% of it to pass to your wife. That doesn't make any sense, or your husband. So the portability concept means now she can leave it all to me because it's ours anyways. Now her lifetime exclusion of $13.61 million, that gets ported to me, it gets transferred to me, and now when I pass away, I can leave the full $27.2 million to my son, right? So that's how that concept works. So when we talk about the double number for married couples, it doesn't just mean if the couple dies. It's generally applicable regardless of how it breaks out, because how that situation is usually going to happen is one spouse passes away, they're going to just leave everything to their spouse. So the spouse now gets, through portability, the full exclusion of their spouse that just passed, and now they have the combined $27.2 million marital exclusion amount. So now let's talk about gifts, gift taxes, and the way these two concepts are linked. Gift taxes are a concept where you pay gift taxes on literally just gifts you give to somebody else, okay? So I give you $50,000, you're my best friend, and I say, hey, I want to help you buy your first house. I give you $50,000. There's a limit per year of how much you can give and not pay any taxes or file any reports. Right now, for 2024, that number is $18,000. And again, that's per donor, per recipient. So if me and my wife, Michelle, wanted to gift my best friend, Tim, right? We want to give him a bunch of money, okay? We could both give him $18,000 for $36,000, but he's also married. So if we want to leave him and his wife money, we could give them up to $72,000. So it is a lot of money. When we talk about couples giving to other couples, like parents giving to their kids and their spouses, and this is all individual. So it's always individual. So it's, I can give 18 to my son. My wife can give 18 to my son. Then I can give 18 to his spouse, and my wife can give 18 to his spouse. So that's how it breaks out. You might see like a check for $72,000, but the way it should be broken out, and just to be safe, you should put some sort of note. I'm giving a gift to my son and his wife, and then my wife gives a gift to our son and his wife. Okay, so that's how that breaks out. So how are these concepts linked? And if you want to give a gift, let's say it's just me to somebody else above $18,000, there's a misconception when people hear this exclusion amount. They think, oh, so I can only give a gift of $18,000, otherwise it's taxed. That's not true. Here's how it works. I give a gift of $20,000. that is $2,000 above the limit, right? So I need to report that. I do not pay taxes on that. I don't pay gift or estate taxes, but the lifetime exclusion amount of $13.61 million, that is a lifetime exclusion, and every gift in excess of that cap, which is $18,000 for 2024, goes against and offsets my lifetime exclusion. So let's use rounder numbers to make this concept clear. I give a $20,000 gift, and let's say the lifetime exclusion amount is $100,000. That $2,000 above the $18,000 exclusion now goes against my lifetime exclusion, and now for the rest of my life, I can only give $98,000 of taxable gifts before I start paying gift taxes on those estate tax rates, okay? So that's how it works. So every gift you give in excess of the $18,000 yearly exclusion, so this one's the $18,000 is yearly, goes against the lifetime exclusion and starts to slowly chip away at it. So if over the course of my life I've given a ton of gifts, and total throughout all those years, those gifts have totaled $180,000, or let's just use a better number. They've totaled $3.6 million above those yearly limits, right? When I die, my estate tax exclusion is now only $10 million because $3.6 million as part of my 13.6 lifetime estate gift tax exclusion has been kind of eaten away by gift taxes, because any gift tax in excess of the yearly exclusion eats away at your lifetime exclusion, and that exclusion is shared by estate and gift taxes. So you can see now that these two taxes and these two concepts are very closely linked, and they share a lifetime exclusion. So some people don't care. If I'm going to die with $4 million and I want to help my son buy a home, it just means I have to file an extra form on my tax return. It's not a huge deal. I can give my son $200,000 to buy his first home. We can give my son 18, my wife gives my son 18, I give his spouse 18, my wife gives his spouse 18, right? So we can do that. 72,000 of that is good. We're under the cap. And now remember, there's an amount above. And so that $200,000, a total of $128,000. Now I have to report that I gave a gift over the limit. That's going to go against my lifetime exclusion, and it's going to eat away at our estate tax exclusion when we die. Again, a lot of people aren't super focused on the estate tax because they're not going to die with $27.2 million. For a lot of people, you're going to die with nowhere close to that, right? It's okay. Join the club. There's no shame. So what that means is you don't have to be as concerned about giving gifts as a lot of people are. They hear that exclusion amount and they go, oh, I can't give more than 18. I don't want to pay taxes on a gift. I'll give you more next year. Like you're helping your son plan for retirement or buy their first house, or you're helping a friend, whatever it is, right? It's okay. If you're not going to die with $27.2 million and you're married, you can give some extra gifts. It's okay. Just understand that you need to report that to your tax preparer or CPA, and they have to report that on a form so that it's offsetting your lifetime exclusion. So it's often not a real tax consideration, but you need to report it. Make sure that you're not failing that reporting requirement, because that could be significant later on. So let's talk about the way they're linked for people who are high net worth. How do we use these concepts to plan effectively? This is the tax plan. We've got a plan, right? So here's how we plan. $72,000 does not seem like a lot. If you are someone who is worried about the estate tax, which means you will die with an estate over $27 million, right? Is that fair to say? If you're in that boat, you're like, okay, yeah, so like for the 10 years of my life, I'm trying to limit, I'm going to give these, $72,000 worth of free gifts, so to speak, that I can get out of my estate before I die, that I don't have to report, and they don't offset that yearly or that lifetime exclusion. But that's assuming one child and their spouse. This can become very significant. Let's say you retire, you're very wealthy, you're 62. You could live another 20 to 30 years possibly. You might have 6 kids, they're all married. 7 grandkids, and some sisters and brothers and other friends you want to give gifts to. So now if everyone you want to give a gift to, they also have a spouse and you're married, there could be 18 to 25 interested persons in your life that you want to do something nice for before you die. Well, if you multiply $72,000 per year by 15 people, we could be excluding $1 million per year from your estate. Over the course of 20 years, we could chip away a $50 million estate into something pretty close to a $27.2 million estate, so that we've helped people before we've passed, and therefore we've limited that 40% very significant tax liability on the estate, that the value that would have been there if we had just continued to grow and invest our money. So that's really the way, in terms of planning, that these two concepts interact with each other. I hope that makes sense. It doesn't seem significant for someone who's worried about $27.2 million. But when you think about all of the people you might want to give a gift to and where you might want your estate to go, even just having 6 kids, all with spouses and a couple grandkids, you can be chipping away hundreds of thousands of dollars into your estates, that over the course of 15, 20, 30 years that you're estate planning, you're smart, you're doing it early. Decades of that estate planning can give tax-free a lot more money now to the people you want to leave your estate with, even before you die. And now you've lowered taxes, you've helped them out because they've gotten some of those gifts early. And, you've done a really good job minimizing the tax bill and leaving as much of your estate as possible to your children, which is really the plan, right? That's the American dream. You work hard, you have opportunity, you take advantage of that opportunity, and then your descendants have a better generation than you had economically because of how hard you worked. That's the American dream. I can say that that's true for my family. My grandparents were not wealthy at all. My parents did a little better. They still weren't wealthy by any means. They're not rich. I'm doing better than them. Hopefully I'll become wealthy. Maybe not. My goal is going to be to leave my children more wealthy than I was. So that's the dream. And obviously we want to leave as much as possible to our family. There's one last thing that I'll talk about, because for some people, maybe you don't have a lot of surviving family that you want to leave your estate to. Maybe you have other causes that are equally important and both your kids are going to get $10 million anyways. Who cares, right? You can also, there are others, but there's one other major way to lower your estate tax burden, and that is up to, I believe it's 60%. I should have looked this up. I totally forgot to look up this threshold. I want to say it's up to 60%. It might be 50 or 40% of the value of your estate. You can give to charity, any 501c3 qualifying nonprofit organization, and that amount gets excluded from your estate. So if you have a $35 million estate, you've only got 2 kids, or maybe you have 1 kid, and you're like, what the heck is this kid going to do with $27.2 million? He's fine. I don't really want to pay taxes. I worked hard for this money. I want this to go somewhere good. Not that taxes aren't good. This isn't an anti-government podcast, but you're like, I want to help people. I want to see my money at work, right? So what you can do is you can give $8 million to your favorite charity, a church, an organization that does a lot of work in the community, whatever you're passionate about, right? You can do that. And now what that means is now the $8 million gets excluded from your estate. Now you've brought your $35 million estate down to 27, and now the estate that you leave on to your child is 100% tax-free. So now $8 million has gone to Rady's Children's Hospital, whatever you want to give to, it's gone to a good cause. You've still left $27.2 million to your son or your daughter, and no taxes were paid. Everything was officially handed out. So that's the other really important concept to understand. If you have causes you're passionate about, there is a charitable contribution deduction that gets excluded from the estate and can help lower that estate tax bill. Well, that's everything that I wanted to cover today, guys. I hope you understand a little bit better about how gift taxes work. You don't necessarily have to pay taxes on gifts that are over $18,000. They're just going to reduce your lifetime exclusion amount, and you won't pay taxes on gifts until your total lifetime gifts or estate taxes have exceeded that $13.61 million individual limit for your lifetime. I hope this has helped you plan your estate if you're high net worth. I hope this has helped you understand the way gift taxes can be a very powerful estate planning tool prior to your death, and I hope you learned something that you'll consider passing on to other people. As always, please share this with your friends and family. We want to help as many people as we can. Always feel free to leave comments in the videos for any future tax planning tips that you want advice on, or any topics for our other kind of sections of this podcast that you want to hear about personal finance, about investing, about small business, whatever it is. Leave comments about what you want to hear next, and we'll see you next time.